The information provided in this video is for educational and entertainment purposes only and does not constitute professional financial, medical, legal, or insurance advice. The complexities of health insurance policies, both domestic and international, vary significantly based on individual circumstances, providers, state laws, and destination countries. We are not licensed insurance brokers, financial advisors, or medical professionals. Historical trends regarding medical costs abroad and the case studies discussed in this presentation do not reflect potential outcomes for every individual traveler. Always conduct your own exhaustive due diligence, meticulously review your specific policy documents, and consult with a licensed, qualified professional before making any financial or insurance purchasing decisions. Relying on the information presented in this educational video is done strictly at your own risk. Imagine this scenario. You have spent the last 14 months meticulously planning the ultimate European vacation. You have booked the long-haul flights, reserved the boutique hotels in the heart of Rome, mapped out every single cobblestone street you plan to walk, and saved $10,000 to make it all happen. You are an American with excellent health insurance back home. You possess a premium, gold-tier employer-sponsored health plan that covers practically everything from routine checkups to major surgeries. You feel entirely secure. But on day 3, while navigating the breathtaking but treacherous uneven steps of the Amalfi Coast, you take a slight misstep. It is not a dramatic movie-style fall, just a twisted ankle that suddenly, agonizingly, turns into a severe compound fracture. You are rushed to a local Italian medical clinic, which then determines you require an emergency medical transfer to a specialized hospital facility in Naples for immediate orthopedic surgery. You confidently hand the hospital administration your premium American health insurance card, expecting the exact same seamless, copay-only process you experienced back in Ohio or Texas. The administrator looks at the plastic card, shakes her head with a look of pity, and demands a credit card for an upfront, out-of-pocket payment of $45,000 before the surgeon will even scrub in. This is not a hypothetical nightmare constructed to frighten you. This is a recurring documented case study that plays out thousands of times every single year for American travelers crossing international borders. We operate under a massive, incredibly dangerous misconception in the United States. We naturally assume that because we pay exorbitant, world-leading premiums for our domestic healthcare, that impenetrable shield of coverage simply follows us onto the airplane and across the ocean. It absolutely does not. In fact, a recent industry analysis of historical trends revealed that nearly half of all Americans traveling abroad do so without any dedicated travel medical coverage whatsoever, completely unaware that their primary domestic network considers foreign care completely out of network, or far worse, entirely excluded from their policy. The financial devastation of an overseas medical emergency is one of the most underreported, catastrophic risks in the global travel industry. Let us examine the reality of an emergency medical evacuation. Simply getting you from a remote island in Thailand, a safari camp in Kenya, or a mountain trail in Peru back to a hospital facility in the United States capable of treating your specific condition can easily exceed $100,000 out of pocket. And here is the truly terrifying part of the equation. Commercial airlines will not allow you to board a standard passenger flight with a serious, unstable medical condition. This means you are placed at the absolute mercy of private air ambulance companies who routinely demand massive wire transfers before their pilots even begin to fuel the jet. So you are suddenly left staring down a financial abyss, potentially draining your hard-earned retirement accounts, liquidating physical assets, or setting up desperate crowdfunding campaigns just to secure transport home. But what if I told you that avoiding this specific catastrophic scenario often costs significantly less than the price of a single dinner at a mid-range tourist trap? What if there is a specific hidden clause buried in the fine print of your current health plan that you need to audit right this second, before you even think about retrieving your suitcase from the attic? By the end of this comprehensive educational masterclass, we are going to expose the exact limitations of United States domestic insurance abroad. I will show you the precise step-by-step framework for evaluating whether you actually need a standalone travel health policy, or if you happen to be one of the rare, fortunate few who are genuinely protected by their existing coverage. We are opening the loop on the darkest, most expensive secrets of international medical billing, and if you plan on leaving the country anytime soon, you simply cannot afford to look away. Today, we are solving the ultimate travel anxiety for the American tourist. The core problem you face right now is a severe lack of transparent, easily digestible information regarding cross-border healthcare economics. The insurance industry thrives on complex, impenetrable jargon, purposefully burying vital exclusions deep within 50-page summary of benefits documents. As a consumer, you are constantly bombarded with aggressive, fear-based upsells at the airline checkout page, generic credit card coverage that may or may not actually pay out when tested, and highly conflicting anecdotal advice from travel blogs. You are actively asking yourself, do I really need this extra expense? Is this just another corporate mechanism to extract an additional $50 or $100 from my carefully planned travel budget? We are going to systematically dismantle that confusion. This is not a superficial, top-level overview. This is a rigorous analytical breakdown of exactly how international medical billing interacts with American insurance models. We will dissect the harsh reality of Medicare and Medicaid outside of United States territories, exploring the strict geographical limitations that catch thousands of senior travelers completely off guard every single year. We will examine the crucial, often misunderstood differences between standard trip cancellation insurance, which merely protects your prepaid non-refundable travel costs, and comprehensive travel medical insurance, which protects your actual physical well-being and your financial solvency in the event of a medical crisis. Furthermore, we will provide a methodical, step-by-step approach for auditing your current primary health insurance plan. You will learn the specific industry terminology to search for, such as customary and reasonable charges, out-of-network foreign deductibles, and medical evacuation repatriation limits. We will explore historical trends in claims denials, revealing exactly why standard credit card travel protections often fall drastically short when a genuine, multi-day international hospitalization occurs. We are going to examine real-world case studies of travelers who navigated foreign hospital systems successfully, contrasting their strategies with those who faced immense financial hardship, all to extract highly actionable, educational lessons for your own planning. This video serves as your definitive, uncompromising guide to understanding global health coverage from a uniquely American perspective. By removing the emotion and focusing strictly on the raw mechanics of insurance contracts and global healthcare economics, we will empower you to make an informed, strictly analytical decision for your next international journey. You will no longer need to rely on blind assumptions or the vague, unverified promises of a credit card brochure. You will walk away with a concrete, factual understanding of your personal risk exposure and the exact financial mechanisms available to mitigate that risk, ensuring that your next trip abroad remains a cherished, lifelong memory, rather than a debilitating financial burden. We are diving deep into the fundamental architecture of travel health insurance, and this journey begins by completely rethinking everything you thought you knew about your American healthcare plan. Let us look at a standard premium health insurance policy issued right here in the United States. You pay your premiums every month, you meet your deductible, and you feel a profound sense of security. But the exact moment your flight crosses international waters, that localized safety net evaporates into thin air. The vast majority of domestic health insurance providers operate on a strict network system. They have pre-negotiated rates with specific hospitals, clinics, and doctors within a defined geographical area inside the country. When you step off an airplane in Tokyo or Paris or Buenos Aires, every single medical facility in that country is considered completely out of network. And in the complex, unforgiving world of American medical billing, out of network almost always translates directly to out of pocket. Consider the case study of a traveler we will call David, a software engineer from Seattle, who in the spring of 2026 decided to hike the Inca Trail in Peru. David had an exceptional employer-sponsored health plan. He felt completely protected and financially bulletproof. On day 2 of the high-altitude trek, David experienced severe altitude sickness that rapidly escalated into high-altitude pulmonary edema, a potentially fatal condition if not treated immediately by medical professionals. He required an emergency helicopter evacuation from the mountain directly to a specialized clinic in Cusco. The helicopter extraction alone cost $22,000. The subsequent 4-day stay in the intensive care unit, including specialized oxygen therapy and continuous cardiac monitoring, added another $30,000 to the mounting bill. When David contacted his American insurance provider from his hospital bed, he received a devastating reality check. His domestic policy explicitly stated that foreign medical care was only covered in life or death emergencies, and even then, only at what the insurance company deemed customary and reasonable rates based on United States pricing models, not the actual billed cost. Furthermore, the insurance company argued that the helicopter evacuation was a logistical transportation expense, not a strictly medical one, and denied that portion of the claim entirely. David was forced to drain his entire emergency savings account and max out 3 high-limit credit cards just to secure his release from the Peruvian hospital. Because foreign medical facilities simply do not bill you later. They demand payment upfront or before discharge. This is not an isolated incident meant to scare you. Historical trends show a consistent pattern of domestic insurance providers aggressively scrutinizing and frequently denying claims originating from outside the United States. They will demand meticulously translated medical records, heavily detailed itemized bills, and rigorous, indisputable proof that the situation was a genuine, unforeseen emergency rather than a pre-existing condition or a routine medical need. Even if your domestic provider eventually agrees to cover a fraction of the foreign medical bill, the reimbursement process can take months or even years of exhausting administrative appeals, leaving you to shoulder the massive financial burden in the interim. Now, imagine if you are an older traveler relying on Medicare. This is a demographic that travels internationally at incredibly high rates, yet remains dangerously uninformed about their true financial risk exposure. Let me be absolutely clear. As an educational baseline, standard Medicare Parts A and B provide absolutely zero coverage outside the United States and its territories. None. If you are exploring the ancient ruins of Greece or taking a river cruise down the Danube in 2026, and you suffer a heart attack or a severe slip and fall, the United States government will not contribute a single penny toward your foreign medical bills. There are extremely rare, highly specific geographic exceptions, such as if you are traveling directly between Alaska and the contiguous United States via Canada and a Canadian hospital happens to be closer than the nearest American facility, but for the vast majority of international vacations, traditional Medicare is entirely useless. Some Medicare Advantage plans or Medigap policies, specifically plans C, D, E, F, G, H, I, J, M, and N, do offer a foreign travel emergency benefit. However, this is where the fine print becomes incredibly treacherous for the consumer. These plans typically only cover 80% of the billed charges for medically necessary emergency care outside the United States, and only after you meet an annual deductible. More importantly, there is a strict lifetime limit on this specific coverage, usually capped at a maximum of $50,000. In the context of modern global healthcare costs, $50,000 is alarmingly inadequate. Let us analyze the potential outcomes of a severe medical crisis abroad to understand exactly why a $50,000 limit is a financial disaster waiting to happen. The most catastrophic expense you can face is not the hospital room itself, but the medical evacuation required to get you to a facility capable of treating your condition, or the medical repatriation required to fly you back to the United States for long-term recovery. If you suffer a major stroke while on a safari in rural Botswana, the local clinic will not have the neurological specialists or the advanced imaging equipment needed to save your life. You will require a heavily coordinated medical evacuation on a privately chartered, medically equipped jet, staffed by a critical care nurse and a specialized physician. Based on historical data from the global medical transport industry, a private air ambulance from Southern Africa to an advanced medical center in Europe or the United States can easily exceed $150,000. A transport from Southeast Asia to the American West Coast can surpass $200,000. These are not exaggerated figures. These are the standard baseline costs of deploying specialized aviation assets, securing international overflight permits on incredibly short notice, and compensating highly trained medical personnel for a multi-day transport mission. Your $50,000 Medigap limit would be entirely exhausted before the air ambulance even took off from the runway. Your domestic employer-sponsored plan would likely refuse to pay for the private jet entirely, arguing that commercial transport is the only covered method of repatriation, completely ignoring the absolute fact that commercial airlines strictly prohibit passengers requiring continuous oxygen or intravenous medications from boarding their passenger aircraft. This leaves you trapped in a foreign hospital, potentially receiving substandard care, while your family frantically attempts to liquidate assets back home, sell vehicles, or take out massive personal loans to wire hundreds of thousands of dollars to a private aviation company. This is the exact scenario that comprehensive travel health insurance is explicitly designed to prevent. A dedicated travel medical policy steps into this massive void, acting as primary coverage that completely bypasses the out-of-network penalties and the geographical limitations of your domestic plan. When properly structured, these specialized policies offer $500,000 to $1 million in emergency medical evacuation and repatriation benefits, ensuring that if the absolute worst-case scenario unfolds, the immense financial logistics are handled directly by the insurer, not by your terrified family members. But recognizing that your domestic health insurance is drastically insufficient is only the first step in this analytical journey. The immediate logical counterargument that most savvy travelers make is that they simply do not need to purchase a standalone travel insurance policy because they booked their entire vacation using a premium, high annual fee travel rewards credit card. These credit card companies aggressively market their built-in travel protections, leading millions of Americans to falsely believe they possess ironclad medical coverage simply by swiping a heavy piece of metal. You might be holding one of these premium cards in your wallet right now, completely convinced that you are fully protected against any medical disaster abroad. But what if I told you that relying on that credit card is the single most dangerous financial gamble you can make on your next international trip? What if the microscopic fine print on those benefit guides contains a hidden trap that triggers massive claims denials exactly when you are the most vulnerable? We are about to tear apart the highly polished marketing brochures of the biggest credit card issuers in the world, and you will be utterly shocked by what they are actually legally obligated to cover. The illusion of absolute security provided by a premium travel rewards credit card is arguably the most dangerous financial trap modern American travelers face. We have been conditioned by brilliant marketing campaigns to view these heavy, metallic cards as impenetrable shields. You pay an annual fee of $500, $600, or perhaps even $700. In exchange, the glossy brochure promises airport lounge access, statement credits, and what is vaguely described as comprehensive travel protection. You see the word protection, you see the massive global brand of your credit card issuer, and you naturally conclude that you are fully insulated against any medical catastrophe abroad. This is a profound misunderstanding of how the financial architecture of credit card benefits actually operates in the real world. Credit card companies are financial institutions primarily focused on transaction processing and lending. They are not health insurance underwriters. Therefore, they outsource these travel protections to third-party global benefit administrators. These administrators have one primary fiduciary duty, and that is to mitigate the financial losses of the insurance syndicate, not to write you a blank check when you are lying in a foreign hospital bed. To understand the severe limitations of this system, we must dissect the critical difference between trip cancellation coverage and travel medical coverage. When you read the benefits guide of a premium credit card, the large, bold numbers you see, often boasting coverage up to $10,000 or $20,000, are almost exclusively dedicated to trip cancellation or trip interruption. This means if you break your leg the week before your flight to Tokyo, the credit card might reimburse you for the non-refundable airline tickets and the prepaid hotel rooms. That is property and casualty insurance. It protects your sunk costs. It has absolutely nothing to do with paying a foreign surgeon to repair that broken leg if the injury happens after you land in Japan. The actual emergency medical and dental coverage, embedded within even the most elite credit cards, is shockingly inadequate. Historical trends reveal that many of the most popular travel credit cards in the United States cap their emergency medical coverage at a mere $2,500 to $5,000. In the context of global healthcare economics in the year 2026, a $5,000 limit is effectively useless. It might cover a brief emergency room visit for a minor laceration or a simple course of antibiotics for traveler's sickness, but it will not even begin to cover the cost of an emergency appendectomy, an orthopedic surgery, or an overnight stay in an intensive care unit in Western Europe or developed parts of Asia. Let us ground this in a highly realistic case study. Imagine if you are Sarah, a 34-year-old architect from Chicago. It is the summer of 2026, and Sarah has just landed in Costa Rica for a 2-week surfing and ecotourism vacation. She booked everything on her elite travel credit card, feeling completely secure. On day 4, while riding a rented motor scooter on a wet, unpaved road near Tamarindo, she loses control and suffers a severe tibial plateau fracture. She is transported to a private, high-quality medical clinic in San Jose. The orthopedic surgeon informs her that she requires immediate surgery to insert plates and screws, followed by 5 days of inpatient recovery. The hospital administrator hands Sarah an estimated bill for $18,000 and politely requests a credit card for the deposit before the surgeon will operate. Sarah confidently hands over her premium metal credit card and tells them to contact the benefit administrator. This is the exact moment the illusion shatters. Sarah discovers the devastating reality of secondary coverage. Nearly all credit card travel medical insurance is strictly secondary. This means the benefit administrator is the payer of last resort. When Sarah calls the number on the back of her card, The representative explains that they will not provide an upfront guarantee of payment to the Costa Rican hospital. Instead, Sarah must pay the entire $18,000 out of her own pocket, either by draining her bank accounts or maxing out her credit limit. Then, she must fly home and submit the entire foreign medical bill to her primary domestic health insurance provider in Illinois. As we established previously, her domestic provider will systematically deny the claim because the care occurred completely out of network in a foreign country. Sarah must wait 30 to 60 days for her primary insurance to process the claim and issue a formal explanation of benefits, indicating a complete denial. Only after Sarah receives that official denial letter can she finally open a claim with her credit card's benefit administrator. But the administrative nightmare is just beginning. To even have her credit card claim reviewed, Sarah must submit a massive dossier of documentation. She needs the original itemized hospital bills translated into English. She needs the attending physician's clinical notes detailing the exact nature of the injury and proving it was an unforeseeable emergency. She needs copies of her original flight itinerary to prove the trip was purchased with that specific credit card. She needs police reports if applicable to the scooter accident. If Sarah is missing a single page, the benefit administrator will kick the claim back, restarting the clock. Historical trends show that travelers relying on secondary credit card coverage can wait 6 to 9 months to receive reimbursement, carrying massive, high-interest credit card debt the entire time. And if Sarah's credit card policy happens to be one of the many that caps emergency medical at $2,500, she has just spent 9 months fighting an administrative war only to be left with $15,500 of permanent, out-of-pocket debt. Furthermore, we must examine the highly restrictive pre-existing condition clauses buried deep within credit card benefit guides. Standalone travel insurance policies often offer waivers for pre-existing conditions if you purchase the policy within a few weeks of your initial trip deposit. Credit cards almost never offer this waiver. Their definition of a pre-existing condition is incredibly broad and ruthless. If you experienced any changes in your medical status, including a simple adjustment to a prescription dosage for blood pressure or asthma within the 60 to 90 days prior to your departure, the credit card benefit administrator will immediately classify that as a pre-existing condition. If you suffer a medical emergency abroad that they can even vaguely link to that adjusted medication, your claim will be instantly denied. They will request your stateside medical records to investigate your health history, actively searching for a reason to avoid paying the claim. Even the emergency medical evacuation benefits on premium credit cards, which often boast limits of $100,000, contain massive logistical traps. The fine print dictates that the benefit administrator's own medical team must unilaterally decide if an evacuation is medically necessary. If the local foreign doctor says you need to be flown back to the United States, but the credit card's doctor sitting in an office in Ohio disagrees and claims the local facility is adequate, you will not be evacuated. If you or your family panic and arrange a private medical flight without getting explicit, prior authorization from the credit card company, the entire coverage is completely voided. You are entirely at the mercy of a third-party corporation's internal protocols during the most terrifying moments of your life. The harsh reality is that credit card travel protections are explicitly designed to handle routine travel inconveniences like lost luggage, delayed flights, and minor trip interruptions. They are fundamentally not engineered to manage complex, high-cost international medical emergencies. Relying on them to protect your physical and financial well-being is a catastrophic miscalculation. So, if your domestic health insurance explicitly abandons you at the border, and your premium credit card is an administrative mirage designed to avoid paying out massive claims, what is the actual structural solution for an American traveling abroad? We must pivot our focus to the only mechanism designed specifically for this exact problem, which is standalone, comprehensive travel medical insurance. But you cannot simply go to a search engine and purchase the very first, cheapest policy that appears on your screen. The travel insurance market is flooded with low-quality products that utilize the exact same deceptive secondary coverage models as the credit cards. There is a massive, critical difference between a policy that acts as primary coverage versus secondary coverage, and failing to understand this distinction will leave you facing the exact same financial ruin we just outlined. Let me show you exactly how to dissect a standalone policy document like a forensic auditor, because the secret to real protection lies hidden in a few highly specific sentences. The very first clause you must search for in any policy document is the designation of coverage order, specifically whether the medical benefit is classified as primary or secondary. Most budget travel insurance policies, the ones heavily promoted on discount travel aggregators, operate strictly as secondary coverage. This means they force you to exhaust your domestic United States health plan first, completely mirroring the administrative nightmare we just outlined regarding credit card protections. Primary coverage is the undisputed gold standard of global travel insurance. When a policy is designated as primary, it means the travel insurance company steps forward as the first and only payer the moment a medical emergency occurs. They do not ask you to file a claim with your employer-sponsored plan in the United States, and they do not wait for a domestic denial letter. Let us look at a historical trend from the year 2026 to understand how this drastically alters the outcome of an emergency. Travelers who secure primary coverage experience a significantly different reality when navigating foreign healthcare infrastructure. Imagine if you are Michael, a 55-year-old engineer from Ohio, taking a highly anticipated river cruise down the Rhine in Germany. On day 3, Michael experiences severe, crippling abdominal pain and is rushed via ambulance to a local hospital in Cologne, ultimately requiring an emergency appendectomy. Because Michael purchased a standalone policy with primary medical coverage, the logistical friction is entirely eliminated. His travel companion simply hands the German hospital administrator the travel insurance card and immediately calls the 24-hour global assistance hotline listed on the back. The travel insurance company opens a direct, multilingual line of communication with the hospital administration. They issue what is known in the global medical industry as a guarantee of payment. This is a legally binding financial instrument, typically sent via secure fax or encrypted email, assuring the foreign medical facility that the entire bill will be covered directly by the insurer. Michael undergoes surgery, recovers for 4 days in a private room, and walks out of the German hospital without swiping his own credit card for a single euro. His domestic insurance company back in Ohio is never even aware the event occurred. That is the immense power of a primary coverage designation. Once you have confirmed the policy is primary, you must relentlessly scrutinize a highly deceptive phrase that insurance underwriters love to bury deep within the benefit summary. The exact phrase to search for is customary and reasonable charges. When an insurance company agrees to pay a foreign medical bill, they rarely agree to pay whatever arbitrary number the hospital generates on the invoice. They legally bind themselves to pay only what is considered customary and reasonable for that specific geographic area. If a private, luxury clinic in Switzerland bills your insurance $80,000 for an orthopedic procedure that statistically costs $20,000 at a public Swiss hospital down the street, the insurance company will aggressively cap their reimbursement at the $20,000 mark. You are then legally responsible for the remaining $60,000 balance, a practice known as balance billing. To protect yourself from this devastating trap, you must look for policies that explicitly state they cover the actual billed charges up to the policy limit, or you must verify that their global assistance team is contractually obligated to actively negotiate the rates down to a zero balance before you are officially discharged. The next vital sentence you must hunt down like a forensic auditor is the definition of the look-back period regarding pre-existing conditions. This is where historical data shows the highest percentage of catastrophic claims denials for American travelers. A pre-existing condition is not just a major, life-altering illness like cancer or advanced heart disease. In the strict eyes of an insurance underwriter, it is any medical condition for which you have exhibited symptoms, consulted a physician, received diagnostic testing, or simply had a change in medication during a specific window of time leading up to the exact date you purchased the policy. This strict window is the look-back period, and it is typically 60, 90, or 180 days. Let us explore a highly realistic case study to understand exactly how weaponized this specific clause can be against a traveler. Imagine if you are David, a 62-year-old retiree from Florida, planning a massive 3-week tour of New Zealand in the fall of 2026. David has mild hypertension, managed perfectly with the exact same daily pill for 10 uninterrupted years. However, 45 days before purchasing his travel insurance policy, David visits his local cardiologist for a routine annual checkup. The doctor decides to slightly adjust his dosage, switching him from 10 milligrams to 20 milligrams for optimal performance. David feels fantastic and his blood pressure is perfect. While hiking in New Zealand, David suffers a minor cardiac event requiring a brief hospitalization. He submits the claim to his travel insurance company, completely confident in his coverage. The insurance company requests his stateside medical records, sees the routine dosage adjustment 45 days prior, and outright denies the entire $40,000 claim. Why does this happen? because that simple preventative dosage change occurred within the 60-day look-back period, technically classifying his highly stable hypertension as an unstable pre-existing condition. There is only one structural guaranteed defense against this nightmare scenario, and it is called the pre-existing condition waiver. This is not a separate insurance policy you can buy. It is a time-sensitive clause embedded within premium policies that entirely waives the look-back period, effectively covering your pre-existing conditions, as long as you are medically stable to travel on the day you purchase the insurance. But here is the massive logistical catch that catches thousands of Americans completely off guard every single year. You cannot simply buy this waiver a week before your flight departs. Industry standards and underwriting rules strictly mandate that you must purchase your travel insurance policy within a very tight window, usually 14 to 21 days after you make your very first, initial trip payment. That means the exact day you put down a $200 non-refundable deposit on your flight or your guided tour, the countdown clock starts ticking. If you wait until day 22 to finally buy your insurance, the waiver is permanently off the table, and your entire medical history is forever subject to forensic scrutiny in the event of a claim. We must also critically evaluate the specific language surrounding hazardous activities. American travelers frequently operate under the fundamentally flawed assumption that a standard medical policy covers them regardless of what physical activities they are participating in. Every single policy contains an extensive, non-negotiable list of excluded activities. If you are planning a trip to Costa Rica in 2026, your itinerary might include zip-lining through the canopy, scuba diving, or whitewater rafting. These are standard, widely promoted tourist activities. However, an overwhelming majority of baseline travel insurance policies explicitly exclude any injuries sustained during what they classify as adventure sports. If you shatter your collarbone falling off a rented all-terrain vehicle or suffer severe decompression sickness while diving, and you only possess a standard baseline policy, your claim will be instantly and irrevocably denied. You must scour the policy documentation for an optional adventure sports rider. This is an explicit add-on that specifically overrides those exclusions, usually requiring a modest 20 to 30% increase in your total premium. It is the absolute difference between total coverage and total financial ruin if your vacation involves anything more strenuous than walking through a museum or sitting by a resort pool. Furthermore, we must meticulously evaluate the underlying structure of the medical evacuation benefit. Do not simply look at the massive dollar amount and assume you are safe. You must locate the phrase medical necessity. Who exactly holds the power to determine if a private air ambulance is actually necessary? You want a policy that explicitly states the decision is made jointly by the local attending physician and the insurance company's medical director. If the legal text states that the insurance company has sole, unilateral discretion over the evacuation, you are operating at a massive, dangerous disadvantage. They possess a direct fiduciary incentive to keep you in the foreign hospital if it is mathematically cheaper than flying you home, even if the quality of care is marginally lower than what you would receive in the United States. You must also verify if the policy includes a comprehensive repatriation of remains clause. It is a deeply uncomfortable topic to discuss while planning a vacation, but the logistical and bureaucratic costs of returning a deceased individual across international borders are absolutely staggering, routinely exceeding $20,000 in specialized transport and consular processing fees. A high-quality policy absorbs this entire tragic burden, protecting a grieving family from navigating complex international bureaucracy during their darkest hour. By dissecting these specific clauses, primary versus secondary designation, customary and reasonable caps, look-back periods, waiver windows, and strict activity exclusions, you fundamentally transition from a vulnerable consumer into an informed, highly strategic traveler. You are no longer purchasing a vague, emotionally driven promise. You are actively securing a legally binding financial contract engineered to perform precisely when you need it most. But even if you structure the absolute perfect gold-tier travel insurance policy, complete with primary coverage, pre-existing waivers, and $1 million in evacuation benefits, there is one massive, terrifying blind spot that no insurance broker will ever openly discuss with you. There are specific geographic regions, incredibly popular global tourist destinations, where your premium insurance policy is effectively worthless the moment you arrive. In these specific countries, local medical facilities categorically refuse to communicate with foreign insurance companies. They will quite literally stand in the doorway of the emergency room, block your entry, and demand thousands of dollars in physical cash or an immediate bank wire transfer before they even look at your injuries. If you are planning to visit one of these high-risk medical zones without a highly specific financial strategy, you are walking blindfolded into a trap. We are going to expose exactly which countries operate this way and the specific loophole you absolutely must use to survive their uncompromising healthcare systems. The harsh reality of global healthcare economics is that a premium insurance document, even one boasting $1 million in primary coverage, is ultimately just a promise printed on a piece of paper. And in dozens of highly popular tourist destinations around the world, medical facilities categorically refuse to accept promises from corporations located 10,000 miles away. They operate on a strict, unyielding zero-trust model. We are talking about remote island clinics in Southeast Asia, private specialty hospitals in parts of Central and South America, and regional medical centers across sub-Saharan Africa. In these specific environments, the local administrators have experienced decades of historical trends where American insurance companies either take 6 months to process a wire transfer or aggressively deny claims on technicalities after the patient has already flown home. Consequently, these foreign facilities have instituted a rigid, non-negotiable policy. They demand physical cash, a localized bank wire, or an immediate, high-limit credit card swipe before they will even triage your injuries. Imagine if you are Mark, a 42-year-old high school teacher from Austin, Texas. It is November of 2026, and Mark has saved for 3 years to take his wife on an anniversary trip to a remote, picturesque island in Indonesia. Mark did his research. He purchased a top-tier, primary travel medical policy with zero deductible and a massive evacuation benefit. He is the definition of a responsible traveler. On the 4th day of their trip, while riding a rented motor scooter back to their villa, Mark strikes a patch of loose gravel, loses control, and suffers a severe compound fracture of his right femur. He is transported in the back of a local truck to the only private medical clinic on the island. Mark is in agonizing pain, but his wife confidently approaches the admissions desk and presents their premium travel insurance card. The administrator looks at the American phone number on the back of the card, shakes his head, and hands it right back. He politely but firmly explains that they do not initiate international phone calls to American insurance call centers. He informs Mark's terrified wife that the surgical team is ready, but they require an immediate, upfront deposit of $25,000 to begin the procedure. Mark's wife pleads with them. She explains that they have $1 million policy. She begs the administrator to just send an email or a fax to the global assistance team to secure a guarantee of payment. The administrator refuses. He explains that a guarantee of payment from an American underwriter does not pay his surgical staff today. He points to the credit card terminal on the desk. This is the precise, terrifying trap that catches thousands of fully insured American travelers every single year. You have the coverage, but you lack the immediate liquidity to unlock the medical care. Mark and his wife are forced to frantically call their banks back in Texas, in the middle of the night across a 12-hour time zone difference, begging for emergency credit line increases and attempting to bypass fraud alerts just to authorize a massive international swipe. If their credit cards decline, or if their combined limits do not reach $25,000, Mark simply does not get the surgery. He sits in a holding room, stabilized but untreated, until the funds materialize. To survive this uncompromising system, you must utilize a highly specific, two-tiered strategic loophole that veteran global travelers and international risk managers employ. The first tier of this strategy is the financial bridge. You must never travel internationally without a dedicated, high-limit credit card that possesses zero foreign transaction fees, and crucially, you must keep the balance on this specific card at absolute zero before you board your flight. This card is not for dining, it is not for souvenirs, and it is not for excursions. It is your dedicated emergency medical bridge. Its sole purpose is to absorb that terrifying upfront deposit at the clinic door, forcing the hospital to treat you immediately. The second tier of this loophole is understanding how to bypass the stateside call center of your insurance provider. When you are standing in a cash-only clinic in rural Mexico or a private hospital in Thailand, calling a toll-free number in Ohio is a strategic failure. The operator in Ohio has no leverage and no local relationships. Instead, you must immediately demand to be connected with your travel insurance provider's regional field agent or local network coordinator. High-quality travel insurance companies do not just have an office in the United States. They contract with regional assistance networks operating specifically in Asia, Latin America, and Europe. These local fixers operate in the same time zone, speak the local language fluently, and most importantly, they hold pre-established financial relationships and direct billing agreements with the major medical facilities in their designated region. If Mark's wife had bypassed the main hotline and directly contacted the insurance company's Southeast Asia regional desk in Singapore, that local agent could have leveraged their existing corporate relationship with the Indonesian clinic to authorize the surgery without the $25,000 physical swipe. Furthermore, if you find yourself entirely gridlocked with the hospital administrator who refuses any form of corporate communication, your ultimate trump card is the Consular Services Division of the local United States Embassy. While the embassy will never pay your medical bills, their local staff can act as high-level, authoritative liaisons. When a consular officer contacts a local hospital administrator in their native language to formally verify the validity of your insurance policy and the imminent transfer of funds, the administrative blockade often vanishes instantly. The embassy establishes the institutional trust that your piece of plastic completely lacks. By understanding the absolute necessity of a dedicated high-limit credit bridge and the precise communication protocols required to activate local field agents, you effectively neutralize the threat of the cash-only medical trap. You transform a potentially fatal administrative standoff into a seamless logistical transaction. You pay the bridge cost, you receive the life-saving medical care, and your physical well-being is secured. But surviving the hospital and getting discharged is only half of the battle. You now hold $30,000 of foreign medical debt on your personal credit card, and you must force your travel insurance company to reimburse every single penny before the interest rates destroy your financial life. This is where the true bureaucratic war begins. The insurance adjusters will deploy an arsenal of highly technical denial tactics, scrutinizing every single code on your foreign invoice. If you submit your reimbursement claim using the standard generic forms, you are virtually guaranteeing a devastating rejection letter. We are going to expose the exact, meticulously structured dossier you must build before you even leave the foreign hospital, detailing the specific medical codes, the mandatory physician signatures, and the exact translation protocols you absolutely must secure to legally compel your insurance company to release your money. The administrative war for your reimbursement begins the second you are stabilized in that foreign hospital bed, not when you return to American soil. If you wait until you are back in your living room in Ohio to start gathering documentation, you have already lost. The insurance company's claims department operates on a foundation of strict, clinical evidence. If a single piece of the evidentiary chain is missing, or if the terminology used by a foreign doctor does not align with the specific international classification of diseases codes used by American insurers, your claim will be systematically flagged for manual review, which is industry shorthand for a 6-month delay or an outright denial. To prevent this, you must act as a forensic medical auditor while you are still physically present in the foreign facility. Let us look at the case study of James, a 48-year-old project manager from Denver, Colorado. In early 2026, James suffered a severe respiratory infection while traveling through rural Vietnam. He was treated at a private international hospital in Hanoi, incurring $6,000 in costs which he paid up front using his emergency credit bridge. James was savvy. He didn't just ask for a receipt. Before he was discharged, he insisted on a meeting with the hospital's international billing coordinator. He demanded a full itemized medical dossier. This is not just a summary of your stay. You must secure a document that lists every single cotton swab, every milligram of intravenous medication, and every minute of nursing care provided. In the United States, we are used to cryptic bills, but for a foreign reimbursement, your insurance company requires the granular data to verify that the charges meet their customary and reasonable threshold. The most critical component of this dossier is the physician statement of medical necessity. You cannot simply have a bill that says emergency. You must have a signed document from the attending physician, ideally on official hospital letterhead, that explicitly details the diagnosis, the acute nature of the symptoms, and a clear statement that the patient was not stable enough to travel back to the United States for treatment. Without this specific sentence, the insurance company can argue that you chose to receive elective care abroad, which is a standard exclusion in almost every policy. James insured his doctor in Hanoi wrote, in English, that his oxygen saturation levels were below 90% and that commercial air travel posed an immediate risk of respiratory failure. This single sentence effectively neutralized the insurance company's ability to claim the hospitalization was optional. Furthermore, you must address the language barrier with extreme precision. While many international hospitals in major hubs like Dubai, Singapore, or Paris provide documents in English, thousands of high-quality facilities in South America, Eastern Europe, and East Asia do not. If you submit a medical report written in Portuguese or Thai to an American claims adjuster, they are under no legal obligation to translate it for you. They will simply return the claim as incomplete. You must secure a certified translation before you leave the country, or at the very least, ensure the hospital provides a bilingual summary of the discharge papers. Historical trends show that claims submitted with professional, third-party translations are processed 40% faster than those that require the insurance company to outsource the translation internally. Now, let us discuss the specific trap of medical coding. In the United States, every procedure is linked to a current procedural terminology code. Foreign hospitals often use completely different systems. If your bill simply says surgery, the American insurer has no way of knowing if that was a life-saving appendectomy or a minor cosmetic repair. You must ask the foreign billing office to provide the ICD-10 codes for your diagnosis and treatment. These are international standards recognized by every major insurance carrier in the world. When the claims adjuster sees an SAM code J18.9 for pneumonia or code S82.20 for a fracture of the tibia, the ambiguity vanishes. You have provided them with the exact data points their software is designed to recognize, triggering an automated approval rather than a human rejection. There is also the logistical nightmare of the currency exchange. If you paid 30,000 Brazilian reais for your care, what is the exact US dollar equivalent you are owed? If the exchange rate fluctuates significantly between the day of the procedure and the day the claim is processed, you could lose thousands of dollars in the conversion. To protect your financial interests, you must include a copy of your credit card statement showing the exact US dollar amount that was settled at the time of the transaction. This provides an indisputable record of your actual out-of-pocket loss, preventing the insurance company from using a more favorable later exchange rate to underpay your claim. However, even with a perfect dossier, there is a segment of the American public that faces an even higher level of scrutiny and risk: the digital nomad and the long-term traveler. If you are not just taking a 10-day vacation, but are instead spending 3 months, 6 months, or a year hopping between countries while working remotely in 2026, the standard travel insurance model completely breaks down. Most people don't realize that a standard travel medical policy is designed for a round trip. It requires you to have a defined departure date and a defined return date to your home country. The moment you stay beyond your policy's expiration, or if you cannot prove you have a permanent residence in the United States to return to, your coverage can be retroactively voided. Imagine if you are Chloe, a 29-year-old freelance graphic designer who decided to spend 2026 living in various cities across the Balkans. Chloe bought a standard travel insurance policy, but kept extending her trip month by month. When she fell ill in Albania and required a 3-day hospital stay, her insurance company denied the claim entirely. They pointed to a clause in the fine print stating that the policy was only valid for trips originating and ending in the insured's home country within a 90-day window. Because Chloe had been out of the United States for over 6 months, she was no longer considered a resident under their underwriting guidelines. She was essentially paying premiums for a policy that provided zero legal protection. This brings us to a critical distinction that every long-term traveler must understand. There is a massive structural difference between travel medical insurance and international private medical insurance. One is an emergency band-aid for a vacation. The other is a full-scale replacement for your American health insurance that covers you anywhere in the world, including routine care, prescriptions, and long-term stays. If you are planning to join the millions of Americans working from beaches or mountain towns in 2026, you are likely operating with the wrong type of protection. You are one administrative technicality away from a $100,000 medical bill that no one will pay. We need to look at the specific, high-stakes differences between these two products, and more importantly, we need to address the rising trend of countries that now legally mandate a specific type of high-limit health insurance just across their borders. If you arrive at the gate without the exact right paperwork, you won't just be denied insurance. You will be denied entry into the country. We are going to break down the new global visa insurance requirements for 2026 and the specific countries that will turn you around at immigration if your policy doesn't meet their exact, government-mandated minimums. In 2026, the global landscape of travel has undergone a radical shift. The decision to carry travel health insurance is no longer just a personal risk assessment or a financial strategy. In an increasing number of countries, it is a strict legal mandate for entry. If you are an American traveler who assumes your blue passport grants you unfettered access to the world regardless of your insurance status, you are operating on dangerously outdated information. We have entered the era of mandated medical coverage, where border agents in dozens of nations now function as de facto insurance auditors. If you arrive at the immigration desk without a verifiable, compliant insurance certificate, you will not be granted a visa, you will not be allowed to clear customs, and you will be placed on the next available flight back to the United States at your own expense. Let us analyze the most prominent example of this institutional shift: the Schengen area of Europe. This region, encompassing 29 countries including massive tourism hubs like France, Germany, Italy, and Spain, has codified their insurance requirements into federal law under EU regulation, EC. No. 810/2009. For any traveler requiring a visa to enter this zone, proof of travel medical insurance is 100% mandatory. But even for Americans who currently enjoy visa-free entry for short stays, the implementation of the ETIS, European Travel Information and Authorization System, in 2026 has introduced a new layer of digital scrutiny. While the ETIS itself is a security pre-screening, border officers across the Schengen zone have significantly increased their random spot checks for medical insurance. To be legally compliant in Europe in 2026, your policy must meet 4 non-negotiable criteria. First, it must provide a minimum coverage of €30,000, approximately $33,000, specifically for emergency medical expenses and hospitalization. Second, the policy must be valid in every single member state of the Schengen area, not just your primary destination. Third, it must explicitly cover the cost of medical repatriation and the repatriation of remains in the event of death. Finally, the policy must cover the entire duration of your stay, from the minute you touch down in Lisbon to the second you depart from Berlin. If your insurance certificate is missing even one of these specific clauses, or if it is written in a format that the border agent cannot instantly verify, your entry can be legally denied on the spot. However, the trend extends far beyond Europe. In the Middle East and Asia, countries have introduced even more granular insurance requirements tied directly to their visa and entry systems. In the United Arab Emirates, specifically Dubai and Abu Dhabi, health insurance is no longer a recommendation. It is a legal prerequisite for both tourist and residency visas. As of 2026, the UAE requires visitors to hold a policy that covers at least $30,000 in emergency medical treatment, and for many visa types, this insurance is now automatically bundled into the visa fee itself. Similarly, in Qatar, as of February 2026, a new mandatory health insurance scheme requires all visitors to have a policy issued by a government-approved provider or a recognized international insurer that specifically covers accidents and emergency services within Qatari territory. Consider the case study of Robert, a 50-year-old consultant from Georgia. In early 2026, Robert planned a business trip to Jordan, followed by a week of relaxation at the Dead Sea. Robert was aware that Jordan had recently reinstated a mandatory insurance requirement for all incoming travelers. He purchased a basic travel policy online, but failed to read the specific Jordanian entry requirements. When he arrived at Queen Alia International Airport in Amman, the immigration officer requested his insurance certificate. Robert showed a digital copy on his phone, but the officer pointed out that the policy lacked a specific medical evacuation clause that met Jordan's updated 2026 standards. Robert was prohibited from leaving the airport terminal. He spent 6 hours in a holding area, frantically trying to purchase a compliant local policy through a government website while using unreliable airport Wi-Fi, eventually paying 3 times the market rate just to secure his release and enter the country. This is the new reality of the 2026 travel environment. Countries are no longer willing to absorb the unpaid medical debts of uninsured foreigners. They have realized that the cost of an emergency appendectomy or a motor vehicle accident can bankrupt a local municipality if the victim has no means to pay. Therefore, they have shifted the burden of proof entirely onto the traveler. Beyond Jordan and the UAE, you will find mandatory insurance requirements in Turkey, where insurance is linked to the e-visa process, in Cuba, where you must show proof of a Cuban-approved policy or buy one at the airport, and in Ecuador, specifically for anyone visiting the Galapagos Islands. Even in Thailand, while short-term tourists may experience inconsistent checks, any traveler applying for a long-stay OA or OX visa is now required to show a staggering 3 million Thai baht, roughly $85,000, in health coverage. To navigate this administrative minefield, you must stop treating your insurance certificate as a secondary document. In 2026, your insurance PDF is just as vital as your passport. You must ensure that your provider issues a formal visa letter. This is a specialized one-page document that distills your entire policy into the specific legal language required by foreign embassies and border agencies. It will clearly state your name, policy number, dates of coverage, and crucially, it will explicitly list the coverage amounts for emergency medical, evacuation, and repatriation in both US dollars and euros. High-quality insurers now provide these letters in multiple languages to prevent any possible misunderstanding at a remote border crossing. Furthermore, you must be aware of the 2026 hack being used by savvy travelers to satisfy these mandates without overpaying. Many travelers are now utilizing what the industry calls compliant bridge policies. These are low-cost, high-deductible plans designed specifically to meet the legal minimums for visa entry while providing catastrophic protection. They satisfy the border agent's checklist for a fraction of the cost of a comprehensive plan, but they carry a major risk. They often lack the primary coverage and direct billing features we discussed earlier. You might get into the country legally with a $5 a day bridge policy, but if you actually end up in the hospital, you will still be facing the cash-only nightmare at the admissions desk. This brings us to a critical crossroad in your travel planning. You now understand the domestic insurance gap, the credit card mirage, the necessity of primary coverage, and the legal mandates for entry. But there is one final, specialized category of travel that requires an entirely different level of protection. If your 2026 itinerary involves anything even remotely adventurous, from a high-altitude trek in Nepal to a simple scuba dive in the Great Barrier Reef, you are entering the most dangerous zone for insurance claims. There is a hidden, incredibly precise hierarchy of risk that insurance companies use to classify your activities, and if you accidentally mislabel your trip, you are effectively self-insuring. We are going to expose the exact sports and activities that trigger an automatic, non-negotiable denial, and the one specific sentence you must add to your policy to ensure you are covered from the bottom of the ocean to the top of the mountain. To understand the hierarchy of risk in the eyes of an insurance underwriter, you must first abandon the common-sense definition of what constitutes a dangerous activity. In the world of international travel insurance, the line between a covered excursion and a catastrophic financial denial is drawn with surgical, often arbitrary precision. You might consider a guided scuba dive in the crystal-clear waters of the Bahamas or a scenic hot air balloon ride over the fairy chimneys of Cappadocia to be standard vacation highlights. However, based on historical trends in claims processing, these exact activities are frequently classified as hazardous or extreme, placing them in a specialized category that is explicitly excluded from standard baseline policies. If you do not proactively purchase a specific adventure sports rider, you are essentially gambling your entire net worth on the hope that you do not suffer even a minor injury while participating in these activities. Let us examine the case study of Emily, a 28-year-old graphic designer from Brooklyn, New York. In the summer of 2026, Emily traveled to the Swiss Alps for what she termed a moderate hiking and adventure holiday. She was diligent enough to buy a reputable travel health insurance policy that boasted primary coverage and a high medical limit. On her third day in Interlaken, she decided to try tandem paragliding, a ubiquitous tourist activity offered by dozens of licensed operators in the region. During a particularly turbulent landing, Emily suffered a complex fracture of her pelvis and a ruptured spleen. She was airlifted to a specialized trauma center in Bern. The total cost for the helicopter evacuation, emergency surgery, and a 10-day inpatient stay surpassed $80,000. When Emily's family submitted the claim, the insurance company did not even look at the medical necessity of the surgery. Instead, they pointed to a single sentence in the general exclusions section of her policy document. It stated that the company would not be liable for any loss resulting from aerial activities, including but not limited to paragliding, hang gliding, or skydiving, because Emily had not purchased the adventure sports upgrade, which would have cost her an additional $35 at the time of booking. Her $80,000 bill was legally and irrevocably her own responsibility. The insurance provider's legal team argued that by participating in an excluded activity, Emily had voluntarily increased her risk profile beyond the scope of the standard contract. This brings us to the most dangerous linguistic trap in the insurance industry: the definition of mountain climbing. To a reasonable American traveler, mountain climbing involves ropes, harnesses, ice axes, and extreme technical skill. However, many budget insurance policies define mountain climbing as any activity occurring above a specific altitude, often as low as 9,000 or 10,000 feet. If you are trekking to Everest Base Camp in Nepal, which sits at over 17,000 feet, or even just hiking certain high-altitude trails in the Colorado Rockies or the Andes of Peru, you are technically mountain climbing according to the fine print of many policies. If you suffer from high-altitude pulmonary edema at 12,000 feet and require a helicopter evacuation, your claim could be denied because you were participating in an excluded high-altitude activity without the appropriate technical rider. You must look for the one specific sentence that acts as the ultimate safety valve for the adventurous traveler. This policy includes coverage for all non-professional, recreational activities including, but not limited to trekking up to 6,000 meters, scuba diving with a certified instructor, and organized zip lining. If your policy does not explicitly list the activities you plan to enjoy, you must call the provider and demand a written confirmation of coverage for those specific sports. Furthermore, you must scrutinize the depth limits for scuba diving. A standard adventure rider might cover you down to 30 meters, but if you are an advanced diver exploring a wreck at 40 meters and you suffer a decompression injury, that 10-meter difference is all the insurance company needs to deny a $40,000 hyperbaric chamber treatment. There is also a significant, often overlooked exclusion regarding motorized transport. In 2026, millions of Americans rent motor scooters or all-terrain vehicles while vacationing in places like Greece, Thailand, or Mexico. This is where the intersection of health insurance and licensing law becomes a financial minefield. In the United States, a standard driver's license often allows you to operate a low-power scooter. However, in many foreign jurisdictions, you are legally required to hold a motorcycle endorsement on your license to operate any two-wheeled motorized vehicle, regardless of the engine size. If you are involved in a scooter accident in Bali, and you do not possess a valid motorcycle license from your home state, your travel health insurance will almost certainly deny your claim. They will argue that you were engaged in an illegal act by operating a vehicle without the proper credentials, which is a universal exclusion in insurance contracts. Historical trends indicate that scooter accidents are the leading cause of medical claims for travelers under the age of 40, and the vast majority of these are denied based on the lack of a proper license or the failure to wear a helmet, which is another mandatory safety requirement in the fine print. We must also analyze the potential outcomes of participating in what are known as organized competitions. If you are a marathon runner who travels to Berlin or Tokyo to compete in a world major, your standard travel insurance might exclude any injuries sustained during a race or a competitive event. You are viewed not as a tourist, but as a competitive athlete, which carries a different risk actuarial table. You require a policy that explicitly covers amateur athletic competitions. The same applies to student athletes traveling abroad for tournaments or club teams participating in international friendlies. Even the most cautious travelers, those who avoid motorcycles and high-altitude peaks, can still fall victim to the professional services exclusion. This clause states that if you are traveling for work, and your injury occurs while you are performing your professional duties, your travel health insurance may defer the claim to your employer's workers' compensation insurance. This creates a massive jurisdictional nightmare. Imagine if you are an American architect visiting a construction site in London in 2026. If you trip over a piece of rebar and break your arm, the travel insurance company may argue that the injury is a professional liability, while your domestic workers' compensation provider may argue that they do not cover international incidents. You are left in the middle of a multi-year legal battle between two massive corporations, while the London hospital sends your bill to collections. By understanding the hierarchy of risk and the absolute necessity of activity-specific riders, you effectively close the largest remaining loop in your travel protection strategy. You ensure that your insurance works for the specific way you travel, whether you are sipping wine in a French vineyard or bungee jumping in New Zealand. But there is one final, overarching question that haunts every traveler who has followed this masterclass so far. After auditing the domestic gaps, the credit card failures, the visa mandates, and the activity exclusions, how do you actually determine the exact dollar amount of coverage you need? Is a $100,000 policy sufficient? Or is $1 million just an unnecessary marketing upsell? We are going to reveal the exact mathematical formula you must use to calculate your personal medical risk based on your destination's local healthcare costs and the current 2026 market rates for emergency aviation. We are finally going to answer the question: how much is your life actually worth in the global insurance market? Determining the precise dollar amount of coverage you need for an international trip in 2026 is not a matter of guesswork. It is a mathematical calculation of your maximum probable loss. Most American travelers look at a $50,000 limit and think it sounds like a fortune. They compare it to their $500 deductible at home and assume it will cover any possible scenario. This is the single most expensive assumption you can make. To calculate your true risk, you must separate your insurance policy into two distinct financial buckets: the medical treatment bucket and the medical transportation bucket. Based on historical trends in global healthcare inflation, these two buckets require vastly different levels of funding, depending on your destination and your personal health profile. Let us start with the medical treatment bucket. This covers the surgeons, the hospital room, the medications, and the diagnostic imaging. In 2026, the cost of healthcare is not uniform across the globe. If you are traveling to a developing nation where the cost of living is low, you might assume the medical bills will be equally low. This is a dangerous misconception. While public clinics in rural Vietnam or Bolivia might be inexpensive, as a foreign traveler, you will almost certainly be directed to a private international hospital. These facilities operate on a globalized pricing model, often charging rates that rival or even exceed those of premium American hospitals because they must import their equipment and highly trained specialists. For a major event like a heart attack, a stroke, or a complex multi-stage surgery following a motor vehicle accident, a $50,000 limit will be exhausted within the first 48 hours. Case studies from 2026 show that a standard inpatient stay in a private facility in Singapore or Switzerland can easily reach $10,000 per day before a single procedure is even performed. Therefore, for any trip to a developed nation or a major global hub, the absolute baseline for your medical treatment bucket should be no less than $250,000. However, the medical transportation bucket is where the real financial devastation occurs. This is the cost of the emergency evacuation and the subsequent repatriation. This is the one area where you cannot cut corners, because the price is dictated by aviation fuel costs, international overflight permits, and the scarcity of specialized medical aircraft. Imagine if you are Thomas, a 65-year-old retiree from Phoenix, Arizona, who is on a dream cruise around the coast of South America in 2026. While the ship is between ports near the southern tip of Chile, Thomas suffers a major neurological event. The ship's medical center stabilizes him, but he requires an immediate transfer to a level 1 trauma center in Santiago. The helicopter transfer from the ship to the mainland costs $25,000. After 3 weeks of stabilization in Santiago, the medical team determines that Thomas needs to be flown back to a specialized rehabilitation facility in Arizona. Because Thomas requires a continuous infusion of medication and a pressurized cabin at a specific altitude, he cannot fly on a commercial airline. He requires a private air ambulance. The quote for a private medical jet from Santiago to Phoenix in 2026 is $180,000. If Thomas had purchased a policy with a standard $100,000 evacuation limit, he would be $80,000 short. His family would be forced to bridge that gap in cash before the plane would even leave the tarmac in Chile. This is why for any long-haul international travel, specifically trips to the Southern Hemisphere, Asia, or remote island chains, you must look for an evacuation and repatriation limit of at least $500,000. Some premium policies in 2026 now offer $1 million or even unlimited evacuation benefits for a negligible increase in the daily premium. When you realize that the price difference between a $50,000 limit and a $500,000 limit is often less than the price of a checked bag, the mathematical choice becomes clear. To calculate your specific number, you must use the destination risk multiplier. Take the baseline cost of a private air ambulance from your furthest destination back to your home zip code. You can find these historical trends online or by calling an assistance coordinator. Add that to a potential 30-day stay in a high-end private hospital in that region. If you are going to London, your medical costs are high but your evacuation costs are moderate because of the abundance of transatlantic flights. If you are going to a remote safari lodge in Tanzania, your medical costs in a local clinic might be lower, but your evacuation costs will be astronomical because of the specialized logistics required to land a medical jet on a dirt strip. Another factor in this equation is your age and pre-existing conditions. In 2026, insurance underwriters have become increasingly sophisticated with their pricing algorithms. If you are over the age of 70, your probability of requiring a high-cost medical intervention is statistically higher. In this demographic, a low-limit policy is effectively an empty gesture. You are paying for the feeling of insurance without the actual financial protection. Historical trends suggest that for travelers over 65, a policy with a $1 million combined limit is the only way to ensure that a major health event does not result in the total liquidation of their retirement assets. You also need to account for the deductible strategy. Many American travelers opt for a $0 deductible, thinking it provides the most protection. However, in 2026, choosing a modest deductible of $500 or $1,000 can significantly reduce your premium, while allowing you to allocate those savings toward a much higher total coverage limit. Since the goal of travel insurance is to protect you from catastrophic, life-altering debt, it is far more strategic to have a $1 million policy with a $1,000 deductible than a $50,000 policy with a $0 deductible. You are insuring against the earthquake, not the broken window. Finally, we must look at the fine print regarding the repatriation of remains. It is a grim topic, but in 2026, the cost of returning a body to the United States from overseas can range from $15,000 to $30,000 depending on the local bureaucracy and transportation requirements. Most basic policies cap this at $5,000 or $10,000, leaving the grieving family to navigate international funeral home logistics and massive unexpected costs. A high-quality policy will include a standalone repatriation of remains benefit that is separate from your medical limit, ensuring that the logistics are handled with dignity and without financial strain on your heirs. By applying this analytical framework, separating medical care from transportation, using the destination risk multiplier and prioritizing high limits over low deductibles, you have finally moved past the marketing fluff. You are no longer asking if you need travel insurance. You are now asking exactly which high-limit policy fits your specific itinerary. But even with the perfect policy and the perfect limit, there is one final critical step. How do you actually buy it without getting scammed by a fly-by-night provider? The internet in 2026 is flooded with sophisticated, AI-generated insurance websites that look legitimate, but have zero actual underwriting capacity. If you buy from the wrong company, your policy is just a digital ghost that will vanish the moment you try to file a claim. We are going to reveal the 3 specific industry standard ratings you must check to verify the solvency of an insurance company, and the exact red flags that signal a travel insurance scam is targeting your vacation. We are reaching the conclusion of this masterclass, and the final piece of the puzzle is knowing exactly who you can trust with your life. The vetting process for an insurance provider is the final, most critical layer of your travel security strategy. In 2026, the digital marketplace is saturated with white-label insurance products and sophisticated aggregators that prioritize marketing over actual claims-paying ability. To protect your financial future, you must look past the colorful website and the user-friendly mobile app to evaluate the underlying financial solvency of the company. The first industry standard you must verify is the AM Best rating. AM Best is a credit rating agency that focuses specifically on the insurance industry. You should only consider providers with an A rating or higher, which indicates an excellent ability to meet their ongoing insurance obligations. If a company lacks an AM Best rating or holds a B rating, they may lack the capital reserves necessary to pay out a high-limit medical evacuation claim, especially during a period of global crisis or high claims volume. Furthermore, you must distinguish between the insurance agency and the insurance underwriter. The company whose logo is at the top of the website is often just an administrator or an agency. They handle the sales and the customer service, but they do not hold the money. The underwriter is the massive financial institution that actually carries the risk and pays the claims. You must scroll to the very bottom of the policy document to find the phrase underwritten by. If the underwriter is a recognized global giant like Lloyd's of London, Zurich, or Allianz, you are backed by an institution with centuries of historical trends in managing global risk. If the underwriter is an obscure entity registered in a low-regulation offshore jurisdiction, you are essentially purchasing a piece of paper with no institutional weight behind it. Let us examine the red flags of a travel insurance scam in 2026. One of the most common deceptive practices is the hidden secondary clause. A company may market itself as a primary provider, but deep in the definitions section, they include language stating they are primary only if you do not possess any other valid and collectible insurance. This is a predatory tactic designed to force you back into the arms of your domestic United States health plan, creating the exact administrative deadlock we have worked so hard to avoid. Another major red flag is the absence of a verifiable 24-hour global assistance number. A legitimate international insurer maintains a dedicated, multilingual emergency desk that can be reached from anywhere in the world. If the only contact method is a web form or a bot-driven chat interface, they are not equipped to handle a real-time medical crisis in a foreign hospital. Consider the case study of Linda, a 60-year-old traveler from Pennsylvania. In 2026, Linda purchased a policy from a heavily discounted website that appeared at the top of her search results. The price was 40% lower than the major carriers. When Linda suffered a severe allergic reaction while in Morocco, she attempted to call the emergency number provided. She was met with a pre-recorded message stating that the office was closed for the weekend. When she finally reached a representative on Monday, they informed her that her policy only covered accidents, not sudden illnesses, a distinction that was buried in a 300-page policy manual she was never shown during the checkout process. Linda was left with a $12,000 bill for an ICU stay that the company refused to acknowledge. This is why you must always cross-reference any provider with the Better Business Bureau and third-party review platforms that verify the authenticity of the reviews to ensure you are not looking at AI-generated testimonials. Another critical step in 2026 is verifying the direct billing network. High-quality insurers now provide a searchable database of hospitals and clinics worldwide, where they have pre-established direct billing agreements. If you are traveling to Mexico City or Bangkok, you should check if the major private hospitals in those cities are on your provider's preferred list. If they are, it means the insurance company has a proven history of paying those specific facilities, drastically reducing the potential outcomes where you are forced to provide an upfront cash deposit. If a company claims to have global coverage but cannot name a single hospital in your destination country where they have a billing relationship, they are likely just a reimbursement-only provider, which places the entire initial financial burden on your shoulders. You must also be wary of the automated renewal trap. Some 2026 travel insurance startups utilize a subscription model that continues to charge your credit card long after your trip has ended. While this can be convenient for frequent travelers, the fine print often dictates that the policy only covers trips up to 30 days in length. If you are on day 31 of a long-term journey, the policy may be legally void even if you are still paying the monthly subscription. Always verify the maximum trip duration per segment to ensure your coverage remains active for the entire time you are outside the United States. To finalize your strategy, you must perform a pre-departure stress test of your policy. This is a three-step process. First, download your insurance certificate and the full policy wording to your phone's local storage and print a physical copy. Do not rely on cloud access in a foreign country. Second, save the International Emergency Assistance number as a priority contact in your phone and share it with your emergency contacts back in the United States. Third, call the provider's assistance line before you leave. Ask them a specific hypothetical question about their guarantee of payment process in your destination country. If the representative cannot give you a clear, professional answer, or if the wait time exceeds 10 minutes, you have a clear indication of how they will perform when your life is actually on the line. The ultimate goal of this masterclass has been to transition you from a passive traveler into a strategic manager of international risk. We have moved from the initial realization that your domestic American health insurance stops at the border, through the illusions of credit card protections, and into the granular details of primary coverage, pre-existing condition waivers, and the legal mandates of 2026 immigration. You now understand that travel health insurance is not just an add-on. It is the fundamental infrastructure that allows you to explore the world with genuine peace of mind. You are protecting not just your health, but your family's financial stability and your long-term retirement goals. As we conclude this deep dive, you are now equipped with the exact terminology, the specific questions to ask, and the mathematical formulas to calculate your coverage needs. You can walk into any travel planning session with the confidence of an industry insider. However, even with the perfect medical policy, there is another layer of travel risk that is evolving even faster in 2026. The intersection of geopolitical instability and climate-driven travel disruptions has created a new category of risk that standard travel insurance is often afraid to touch. If your flight is canceled because of a sudden regional conflict, or if you are forced to evacuate a city because of a natural disaster that isn't a hurricane, your medical policy won't help you. There is a specific, high-level category of travel security and non-medical evacuation insurance that is becoming mandatory for the modern global explorer. We are opening a new loop on the future of travel safety, where your physical security is just as important as your health insurance.